Initially, let's look at what do we mean by credit as well as the credit risk. What do we mean by credit? A very easy word for us to understand. Okay, it's simple agreement. A and B have got into an agreement wherein A has provided something to B of some value. Right? A has provided something to B of some value. Probably it could be cash or it could be a commodity. It could be anything which is having some value. And B did not pay for it right now. B did not pay for it right now, but he has agreed very clearly that the payment would happen at a later date. The date is clearly decided at the beginning. The payment schedule is decided upfront. Now this kind of a mechanism which is agreed upon by both the parties is what we are calling as a credit process. And to a large extent we see in any company, right? For any kind of a company, this kind of a process is almost inevitable. Doing business on credit is inevitable. Either they take credit or they offer credit, but something credit can't be taken out from the typical operations. Unless I talk about some small company wherein all transactions are pure cash based, only in that case it exists. Probably the biggest of the companies in the world, we cannot see a situation like this at all. Which means the party who has actually provided the value in the beginning and is expecting the payment for it, that particular party we are calling as creditor, or probably we can call him as lender. Typically in a financial market we use the word lender, whereas this particular party who has taken the benefit, we typically call him as borrower or obliger. Okay, so we can very well see that the creditor at any point, he is taking a risk. So he really needs to have some amount of knowledge about the borrower's character as well as the reputation associated, because it is more about the willingness to pay. Is the borrower willing to repay, or is he going to default on the payment? Right? So the major thing from any creditor standpoint is assess the likelihood, assess the probability that the loan, whatever he is giving, would be repaid at a later date. So whenever he is lending, obviously the creditor is going to think on these lines. Now, what is the credit risk part then? So that is the one small thing which every creditor has to take into consideration before actually lending. But at the same time, he cannot avoid the lending process, because let's say for a bank, probably the only source of revenue for a bank is borrowing and lending. So it's a core operation of the bank. So it cannot eliminate the concept of credit from its operations. But what we are simply saying is the assessment of the credit is very much important. The creditor has to really pay some attention in terms of assessing the borrower. So that's the place where we are talking about a credit risk. It is purely from the perspective of what is the chance. There is some level of probability that the borrower will typically default. He will not pay back the loan as per the terms and conditions which are mentioned as a part of the contract, which means even a delay is something that is very much possible. So what are the different things that get covered as a part of this credit risk? Probably the most common one, defaulting on a loan, covered. Then even the probability of default is increasing, because even if the default probability increases because the situation of the borrower has gone worse because of some reason, the probability of default is increasing. Though he has not defaulted, the chances that he will default is increasing. Even that we call as a credit risk. And the exposure is increased than expected. The total amount that has been, the total amount that is subjected to risk has actually increased than whatever was initially expected, which means the loss could typically go up. Even that is a measure of credit risk. For some reason or the other, I expect that the recovery rate, if at all this person defaults, I may not be in a position to sell off his assets because his assets have gone down in value, which means the recovery rate is going down. Even that is a measure of credit risk. And especially with respect to commodities, we are probably, especially with respect to non-financial transactions, non-financial loans kind of stuff, this kind of specific risk called settlement risk comes into picture. What is this settlement? I have delivered the good. A has delivered the good or a service. He is expecting the payment in return. But this payment does not come at all. So with this kind of items, the risk is called as a settlement risk. Though this is also a form of a credit, a separate name that is coming to it called as the settlement risk. Especially except for cash and carry kind of transactions, for those small companies which go only with this kind of a mechanism, there is always a scope of credit risk, right? So whenever we are looking at broader from the perspective of the credit risk, I can look at it either from the perspective of settlement, which is more and more associated with the goods and services, and then the actual credit risk or a financial obligation, which is purely coming out of the kind of loan agreements that are there between the parties, or the bonds that are defaulting on a bond that has been issued. So this generally we differentiate. This is typically called as a trade credit, whereas this is more associated with a financial obligation. These two are looked differently, but of course the similarity is both of them are the counterparty is typically not able to pay back for whatever the service or the benefit that he has received earlier. So the financial analysis for both the cases I have to do to really understand what is the probability that the party is willing to pay, able to pay, the likelihood that the party would be paying, because there is no way I can go away from that. It's only how well I can manage that risk, how well I can mitigate that risk, how well I can protect myself from a big disaster happening because of that risk, is what is should be looked at from a creditor or a lender's perspective. That is where probably different items like taking a collateral, taking some kind of guarantees or different kinds of aspects come up, because the credit risk decision is a very important decision that needs to be taken. I can't be very strict on it because I lose my business, but at the same time I can't be very liberal on it because I may not get my collections back. So that is where the real crux lies in terms of taking appropriate decision. So the decision making with respect to the credit risk becomes much important for us, right? All right.